we saw this incredible rally, but it was really mostly held by foreign investors, with domestic players sort of staying on the background. So does that mean that we could even go higher?
Yeah, I mean, so Japan, I mean, the return of the domestic investor has disappointed many people over many decades, if that's the expectation for Japan. Look, I think so for us, Japan is a market where nothing happens for long periods of time, and then you get short, sharp periods of outperformance. So that's what we're having right now. What could be different this time? I mean, obviously, in the background, you've still got the improving corporate governance story. It's taken a while. The third arrow back from the beginning of Abenomics is still sort of a long-term driver, but it's a bit of a slow burn. Obviously, one of the things that's happened over the course of this year is that the TSE has put pressure on companies to improve corporate profitability, as they say. So obviously, you've got a big portion of Japan trading below book value. You've got a lot of cash sitting on very conservative balance sheets, and companies have taken this sort of pressure from the TSE to do a number of things, improving dividends, some pretty blockbuster buybacks being announced. That's obviously an easy way to get cash off the balance sheet and improve your valuation and get price to book multiples above 1, which is what the trigger for the TSE. So we think that's a bit different this time. And so the weak yen, we talked a little bit about that earlier. The weak yen is generally a tailwind for Japan, but over time, unless the BOJ continues to do nothing, we should probably expect the yen to strengthen, so offsetting that kind of tailwind. And we think the sweet spot for yen is more around 125 than where it is now.